The credit controlled by Reserve Bank of India means the control of supply of money in the nation. As we know that when country passes with the various phases, whether it is inflation or deflation, right, or recession phase, the country's RBI or Reserve Bank of India has to do various changes in the monetary policies. And when they want to do any changes in the monetary policy, that is called as the credit control, right? That particular thing is called as credit control. It is done to control the supply of money in the nation. If they control this supply of money in the nation, then they can control recession, they can control the inflation phase, right? If it is properly done, they can do all those things. So what are those credit control measures which RBI will take during these all different phases? So there are different credit control phases. So there are certain importance. First, we'll see the importance why credit control is done. First is to obtain stability in the internal price level. There will be stability in the price level. If the prices are going up and the demand for the product is rising, similarly, the income of the person is also declining. Or if there is a reverse situation, when the prices are falling and purchasing power is increasing, so there will be no demand for the product. So to control this all situation, RBI has to have a proper credit control. If the credit control is done properly, then they can control the price level internally within the nation. Then to attain stability in the exchange rate, to have a proper exchange rate between the countries, right? To maintain the value of Indian rupees in terms of dollar, pound, yen, or different currencies, the credit control policy will play a very important role. Similarly, to stabilize money market of a country, right? To control, to improve the money market, right? As we know, there are two important market, money market and capital market, where short-term borrowings and lendings are done in the nation. That is called as money market. And to control the money market, to stabilize it, to run it properly in the nation, the credit control is very important. Then to eliminate business cycles like inflation, depression, or by controlling supply of credit, right? When the business will face the different situations, we have seen business cycles are there. Whether the business will have a inflation phases in the economy, depression phase in the economy. To control inflation or deflation in the economy of the business, the RBI will control a credit. If credit control is done, the business will have either an inflation or deflation phases. Then to maximize income, employment, output in a country, to increase maximum number of employment or income. If the income is increasing, the government will get enough amount of sources. Again, investment can be done. There will be increase in GDP. There will be increase in national income. So particularly output of the country will get increased. Similarly, employment will get increased. Right? Every youth in the country who has been educated, who has been got some skills, and who have certain extra amount of knowledge, even that person can get a proper employment according to his qualification, according to his skills. So employment will get increased in the nation. Then to meet the financial requirement of an economy, not only during normal times but also during emergency or a war. So we don't know when emergency will come or when war will come, when if there is some natural hazards comes, or we don't know, some problem may arise in the future. In that circumstances also, to come out of that natural hazards, war, emergency, the country need to have the enough amount left with them, right? So in that case also, credit control will play a very, very important role to help the economic growth of a country within the specified period of a time. Now finally, the economic growth can happen only with the help of the proper credit control in the nation. So these are the few very important importance of having a credit control in a nation. If the credit control is followed properly, you can achieve these all seven importance, or you can get these all seven proper utilization or importance in the nation. Now, let us go to the next point. What are the methods, or in the other words, we can call it as tools and instruments of credit controls? There are various tools and instruments or methods of credit control. Broadly, they are classified into two types. First is quantitative or general measurements or methods. Then similarly, qualitative or selective methods. In quantitative methods, there are bank rate, open market operations, variable cash reserve ratio, statutory liquid ratio. And in qualitative or selective methods, there are rationing of credit, margin requirements, regulation of consumer credit, control through the directives, publicity, moral session, and direct action. So these are the tools or methods, instruments we can call for the credit control. So let us start with the first broad classification, that is quantitative methods. So a quantitative methods are those which aim at controlling the total volume of credit. These are used to regulate the quantity of credit by bank. By using these methods, the central bank control the amount of credits. All right. So these are those methods which are aiming to control the total volume of money or total supply of money in the nation. If the RBI wants to control the supply of money, whether if they want to increase the supply of money, whether they want to decrease the supply of money. All right. So when they want to do it, so they are going to use first of all the quantitative methods. Under that, as I have told you, whether they are bank rates, whether they are open market operations, or there are variable cash reserve ratios or statutory liquid ratios. So starting for the first quantitative method is bank rate. A bank rate is a rate at which central bank, in India we have a RBI, grants loan to the commercial bank against the government securities and other approved first class securities. The RBI bank adopts cheap and dear monetary policy according to the economic condition of a country. So a bank rate is what RBI the commercial bank to take a loan, or it will grant a loan to commercial bank against the government securities. Commercial banks will be holding certain government securities. They will be having some government bonds, government papers, securities. By taking those government securities as the property with them, and on those government securities, RBI will provide a loan to these all commercial banks. Right, and that particular rate at which it is providing, it is called as bank rate. So now under bank rate, if you see cheap monetary policy and dear monetary policy, there are two things they can do. Cheap monetary policy is RBI decreases bank rate to increase the quantity of credit in the country. This is called as cheap monetary policy. What RBI does is RBI will decrease the bank rate. If the bank rate is decreased, right, suppose the bank rate was 15%, now the bank rate is reduced to 13%. If the bank rate is reduced, that means the quantity of the credit in the country, there will be increase in the quantity of the credit in the country, right? That means RBI, they can grant more loan to the commercial bank. So commercial banks can get enough amount of funds. Increase in the bank rate, decrease cost of credit, decrease in the interest rate. If decrease in the bank rate, what happens finally? Decrease in the cost of credit will happen. And if there is a decrease in the cost of credit, finally decrease in the interest rate, right? RBI will grant a loan to commercial bank, right? And commercial bank, they will decrease the interest rate which they are going to give it to the customers. Ultimately the interest rate will get decreased. Finally, as a result of this, quantity of credit will get increased, which means supply of the credit, right, or supply of money in the nation will get increased. Many customers will approach to the bank, I want housing loan, we want car loan, we want other different types of loans, and supply of money will get increased. So this particular policy of the bank rate is called as cheap policy. They are reducing the bank rate. With that, there will be reducing the cost of credit. With that, there will be reducing the interest rate. So supply of the money or more number of loan will be given to the customers. Second type of the bank rate is dear monetary policy. Now, DR monetary policy means what? RBI in this particular policy will increase the bank rate, right? If the bank rate is some percentage, they will increase the percentage to some other amount. Now, the bank rate will get increased, or RBI increases bank rate to decrease the quantity of the credit. Right here, it will be totally opposite of the cheap monetary policy. When the bank rate is increased, then many commercial bank will be granted less amount of loan. When less amount of loan is granted, the cost of loan will get increased. When the cost of loan will increase, finally, the rate of interest will also get increased. And finally, when rate of interest is increased, the number of customers who are approaching to take a loan, they will see the rate of interest and they will not take that much of loan. Or finally, they can't grant, the RBI or the commercial bank cannot grant that much of loan. Hence, what happens? The supply of money will decrease in the nation. So, this is the second policy. Now, the second is open market operations. Second type of the policy under this is open market operations. So here it refers to deliberate and direct buying and selling of securities and bills in the money market by the central bank. Right? So here what they do is they will buy and sell the securities and bills of the government directly from the money market. Right? When they buy and sell securities from money market, you will find that the total monetary policy will get affected. So purchase and sale of securities may lead to expansion and contraction of money. Expansion of money means increase of money, and contraction means decrease of the supply of money. Right? In the money market, it influences the cash reserve ratio with the commercial bank, and hence these operation control the credit creation power. Right? If this operation is properly done, it will create a credit creation power in the economy. So such policy is called as open market operations. Now, there are two phases in the economy. First is inflation pressure. Second is deflationary pressure. Every economy will either have a deflationary pressure or inflationary pressure. There is some other pressure also that we call as stagflation pressure. Very rarely the economy will go in a stagflation pressure, but generally economy will go either in inflationary pressure or deflationary pressure. In inflationary pressure or inflation, the central bank would sell the government securities to the commercial banks. The bank would transfer the part of the cash reserve to the central bank towards the payment of these securities. Consequently, the cash reserves with the commercial bank will reduce. It would lead to contraction in the credit creation power of the commercial bank. Right? See, this what is that the central bank, what they do is they will sell the securities. Right? When they sell the securities to the commercial bank, they ultimately have to give money to the RBI. And when they give money to the RBI, there will be less money remaining with the commercial bank to give the loan to the customers. And when commercial banks are having less amount of money, there will be contraction. Suppose commercial banks were having some 100 crores, one branch or one particular commercial bank, let us take 1000 crores they were having. Now, if the bank rate or open market operation is done in case of inflation, when RBI is selling the securities in the open market to the commercial banks. Now, when they are selling, when sale is done, there are two things are involved. Right? They are selling the securities. In return, they are taking cash. In return, what they are doing? They are taking cash from the commercial banks. When they are taking cash from the commercial bank, out of 1000 crores, let us take 100 crores or 200 crores, cash has been taken by RBI. Now, how much money is remaining with the commercial bank? Maybe 800 crores out of 1000. Now, money has been reduced. Right? That is called as contraction. Now, less amount of supply will happen in the nation. This is done in case of inflationary pressure. Now, opposite of this, we call it as deflationary pressure. In this situation, the central bank will purchase the securities from the commercial bank. In this process, the cash reserve with the commercial bank will increase and they would be enabled to create more credit. In this situation, what happens? The RBI, what they are going to do is they are going to purchase the securities from the commercial banks. When they purchase the securities from the commercial bank, they will purchase the securities and they will transfer the cash, or the cash reserve ratios will be increased with that of commercial bank. Hence, suppose 1,000 crore rupees was there, when they are purchasing it, they will pay the cash. Let us take some 200 crores additional cash commercial banks are getting. That means again commercial banks will get enough amount. There will be expansion in the amount. So that is done in case of deflationary pressure or deflation phase. This process is called as open market operation. The third is cash reserve ratio is the third requirement or the third monetary policy. It is called as the RBI controls credit through changing in the CRR or cash reserve ratio of the commercial banks. Every commercial bank is required by law to maintain certain percentage of its deposit with the central bank, by which is called as cash reserve ratio. Every commercial bank, they have to maintain certain percentage with the commercial bank, right? And that particular percentage what they are keeping with the commercial Reserve Bank of India, it is called as the cash reserve. The central bank has power to change the percentages of cash reserve to be kept with it. So it can change, right? It has full power and authority to change it, right? If the ratio is increases, the credit creation capacity of the commercial bank decreases. Suppose RBI increases the cash reserve, right, from 10% to 11%. If the cash reserve ratio is increased, now they have to keep, commercial bank have to keep more amount of money as the reserves. Hence what happens, they will get less amount, the amount will get reduced to give loan to the ultimate customers. So here control of the supply or credit will happen. Similarly, if the RBI want to extend the supply of money, if they want to increase the supply of money, what they will do? They will decrease the cash reserve ratio. If the cash reserve ratio is decreased, the commercial bank, they have to keep less amount of money as the reserve with themselves. Then finally what happens? They can give more amount of credit to the customers, right? More amount of loan to the customers. Such particular monetary policy or tool of monetary policy is called as the third important quantitative tool is cash reserve ratio. Fourth is statutory liquid ratio. Every scheduled bank, commercial bank, is required by law to maintain minimum 20% as cash or gold or some unencumbered securities of its total demand and time liability, which is called as statutory liquid ratio. Every bank has to maintain the securities or the gold or any other things like properties or total demand or time liabilities, short-term liabilities with the as the reserves, right? So such statutory liquid ratio maximum or minimum they can keep up to 20%. Minimum generally they have to keep 20%, and they can increase this, right? Below 20% they cannot do it. They can increase up to 21, 23, 24 as the inflation and deflation process are there. They can do according to that. The RBI is empowered to change this ratio, right? As the RBI has the full power to change this ratio, then it is also influenced that credit creation capacity of the bank. It will change the supply of money. Credit creation of all the bank can be done by SLR ratio or statutory liquid ratio. The effect of both CRR and SLR on credit expansion is similar. This is same. Like if SLR, the rate has increased, let us take if the SLR current is 23%, right? Next year, if the SLR is increased to 25%, then what happens is that all the commercial bank or scheduled banks, they have to keep more amount of their deposits, gold, cash as the liquid assets, right? And they will get less amount of money which has to be given to the customers. So credit creation will get decreased if the SLR ratio is increased. Similarly, if the SLR ratio is decreased, credit creation will happen more because the commercial banks will get enough amount of funds. So the penalties are levied by RBI for not maintaining these ratios from scheduled banks. If any of the bank is not maintaining SLR as per the RBI's instruction, then they have to pay a huge amount of penalties for RBI. Okay, these are quantitative methods we have discussed. There are 4 important methods. Which are those? First is There are four important methods. First is bank rate, is the first quantitative method. Second is open market operations. Third is cash reserve ratio. And fourth important method is the statutory liquid ratio, right? Statutory liquid ratio. Now let us go to the second method of tools, which is called as the qualitative methods. Till now we were discussing about quantitative methods. Now let us go for qualitative methods. Qualitative methods are used to effect the use, distribution and direction of the credit. It is used to encourage such economic authorities as desirable and to discourage those which are injurious for the economy. Right? And these methods are also done for control, but this method will not play a direct impact on the credit control. So there are various methods which are changed from time to time, which are called as qualitative methods, like rationing of credit, marginal requirement or margin requirements, regulation of consumer credit, directives, publicity, moral sections, direct actions. Okay, first is rationing of credit. In this method, RBI seeks to limit the maximum of ceiling of loan and advances, and also fixing the ceiling for specific categories of loans and advances. It aims to control and regulate the purpose for which the credit is granted by the commercial banks. In this particular rationing of credit, what RBI does is that's a limit, that for housing loan, this is the particular you can give. For vehicle loan, this is the limit, right? For personal loan, this is the limit. For gold loan, this is the limit. So to control the credit in the nation, instead of going for percentages, like in bank rate, SLR, CRR, we have seen the percentages. There they will play with percentages. RBI will either reduce or increase the percentages. Here, instead of going to the percentages, they will tell amount, that you cannot give more loan than 20 crores, right? Or 200 crores, right? Such amount will be told. Beyond that, that category or sector of loan will not be given, right? So such type of things are called as rationing of credit. Rationing of credit. Now these particular things are done by two things. First is variable portfolio ceiling and variable capital assets ratio. In variable portfolio ceiling, in this, the central bank fixes a ceiling on the amount of loans and advances for each bank, and the bank cannot advance loan beyond this limit. Suppose RBI has told to the syndicate bank that in the year 2020-21, in the coming year, the syndicate bank can give a housing loan of 3,000 crores. So this is the limit they are told. Or for the month, let us take monthly if they are doing, they will tell that 300 crores, right? For the entire 300 crores or 3,000 crores of loan for entire Karnataka for some month. Now beyond that, they do it. Beyond that particular amount, they cannot do it. So such ceiling has been given, such limit has been given, or a line or deadline has been given. So that is variable portfolio ceiling. Particular portfolio will be told. Portfolio in the sense either housing loan or car loan or vehicle loan or gold loan, right? Or personal loan or employment or education loan. So various different types of loan are there. On particular portfolio or a loan or advances, some ceiling or limitation will be made by RBI to control the credit in the nation. The second method is variable capital assets ratio. In this is the ratio which the central bank fixes in relation to the capital of the bank to its assets. Right here, what happens? The central bank will fix a particular capital, or in this ratio, which the central bank fixes in relation to the capital of a bank to its total assets. So here there will be a relation of some commercial bank between the capital of the commercial bank and the total assets. How much is the capital? Right, the total paid up capital and the total assets should not increase. See, loans, if you take about loans, loans are what? Loans are liabilities. Loans are liabilities. If you ask any person what are loans, loans are liabilities. But when you see the loans as per the bank's idea, or as per the bank's financial statements, loans are not liabilities. There are two types of loans recorded in the bank's financial statement. One loan is the loan which they are taking from RBI, which they are taking from government authorities, or they are taking from other international financial agencies or institutions. Loans are liabilities, but there are certain other loans and advances which they have given to the customers. Those loans are assets. Remember, those loans are not liabilities, those loans are assets. Now here what they are doing is that the total assets, right, if they give more and more loans, the total assets of the bank will get increased, right, and it will be more than that of the capital of a bank, right. So here, to control that particular credit, they will tell that till the capital requirement or till the capital of a bank, the total assets has to match. So such variable capital assets ratio will also be calculated by the bank, and that is called as rationing of credit. So any doubts in this?